guys, welcome to Talking Money with Nozi, personal finance made simple. In today's video, I want to talk to you about the taxes that you can expect to pay as a stock market investor. The aim of this video is to calm your fears about taxes because, as you will learn from this video, stock market investments are often taxed at a lower rate compared to income from your salary and interest income from things like savings accounts, retail bonds, and even property income. Let me explain the three types of taxes that you can expect to pay on the stock market depending on the type of investment and whether you decide to sell those investments or not. Now, there are three types of taxes that apply to your normal taxable investment accounts. By normal taxable accounts, I mean any investment account that is not a tax-free savings account, also known as a TFSA. Normal taxable accounts include South African Rand denominated accounts where you can buy shares, ETFs, unit trusts, etc. in rands. They also include your offshore investment accounts like the US dollar or euro or UK accounts where you can also buy shares and ETFs, etc. in foreign currency. The first type of tax that applies to normal taxable accounts is dividend withholding tax for normal shares and normal ETFs. By normal shares and normal ETFs, I mean shares and ETFs that are not real estate investment trusts or REITs for short. If you buy normal shares and ETFs that pay dividends, 15 or 20% of your dividend income is taken by the company paying the dividends before the balance is paid out to you. The second type of tax that applies to normal taxable accounts is income tax for REITs and REIT ETFs. REITs are real estate investment trusts, which are companies that own or manage properties like hotels, office parks, shopping centers, etc. Okay guys, for those that don't know what REITs are or what REIT ETFs are, I just want to show you examples using my Easy Equities account. This is where I invest, right? So under the Easy Equities ZAR, you scroll down to where it says select investment type. We're going to start with equities, so leave it where it says equities. Then here where it says category tags, this is where then we're going to look for real estate investment trusts. So scroll to the right until you get to where it says real estate investment trusts. Once you've selected this, all the companies that you see below are REITs or real estate investment trusts. So some of them might be familiar to you, some of them might not be, but you can see that the names like Accelerate Property Fund, it's already telling you that it is a REIT. This one is actually called A REIT Prop Limited. There is Growth Point Properties, so they will have the name REIT or properties in their name. Redefine Properties, Rebosis Property Fund, Resilient REIT Limited, and Vugile Property Fund, Storage Property REIT, etc. So those are your REITs. What about REIT ETFs? Well, we're going to go here where it says select investment type, click on ETFs. And the way I'll do it, you just type prop. Some of them are called property something, others are called REIT something. So we start with prop and you'll see this is Satrix Property. That's a REIT ETF. Ritway Global Property, that's also a REIT. 10x S&P Global Property, that's also a REIT ETF. SA Property Income, that's also a REIT ETF, etc. Okay, these are the ones with the word prop. Or you could search REIT, for example, and these are the ETFs with the word REIT in them. For real estate investment trusts or REITs and REIT ETFs, you pay tax on the income that you receive at your marginal tax rate. These are the rates of tax for individuals for our current tax year. And as you can see, income tax starts from 18% all the way up to 45%. The third type of tax that applies to normal taxable accounts is capital gains tax when you sell your investments. Capital gains tax does not apply if you don't sell your investments, only when you sell. Let's say you bought shares for 20,000 Rand. Your shares grow in value and 7 years later, you sell them and get 90,000 Rand. Your profit is calculated by saying 90,000 minus 20,000 and that gives you 70,000 Rand. But 40,000 Rand of this profit is free from tax. So 70,000 minus 40,000 gives you 30,000 Rand. But only 40% of that will be taxed at your marginal tax rate. So 40% of 30,000 is 12,000 Rand. If your marginal tax rate is 36%, then the tax that is due to SARS is 36% times 12,000, which is 4,320 Rand. So guys, from a profit of 70,000 Rand, you only pay tax of 4,320. Nice. Now that I have shown you the taxes that apply to normal investment accounts, what about tax-free savings accounts or TFSAs? The only tax that applies to TFSAs is foreign dividend withholding tax of 15%. There is no dividend tax for South African investments, no income tax for REIT ETFs, and no capital gains tax when you sell any of your investments. Now that I've shown you the taxes that are applicable in a normal investment account versus a TFSA, please don't use the TFSA for your kids' education or any other purposes except for long-term investment only because you are running away from taxes. Remember, tax-free savings accounts have annual and lifetime contribution limits. Deposits are limited to a maximum of 36,000 Rand per tax year and a maximum lifetime limit of 500,000 Rand in total. These limits are per individual and are not renewable once used. This means if you take money out of your TFSA, you cannot replace it. By using your TFSA and withdrawing too early, you are just going to lose out on lifetime tax-free benefits as well as the effect of compounding. Guys, just use your normal taxable accounts to invest for things like education, your child's first car, or a deposit for a house, for example. There is no need to be afraid of taxes because in most cases, stock market investments are taxed at a lower rate than even your salary as well. But I know that some people are stubborn, and so if you insist on using a tax-free savings account for education, then please use your own tax-free savings account and mess up your compounding and your limits yourself. It is not fair to use your child's TFSA for their education because you mess up their limits. Let's leave kids out of this. Use your own TFSA if you insist. Anyway guys, the point of this video was to show you that when it comes to stock market investments, the tax rates are often lower than income tax from your salary, income from savings accounts, and income from retail bonds, for example. This is because governments want to encourage people to invest in businesses. Remember, shares are pieces of businesses. And when people invest in businesses, this can lead to job creation and economic development. By taxing capital gains and dividends at a lower rate, people are motivated to invest in the stock market, which ultimately benefits the economy. That's it for today's video. Thank you for joining me today. If you found this video helpful, please give it a thumbs up and share it with your friends. Also, don't forget to subscribe to my channel for more content on investing and much more. Until next time, happy investing.